Something significant is happening in global stock markets right now, and it directly affects your money. Technology stocks surged over 80% in the first half of 2026. Then, last week, they started falling hard. Chip makers dropped sharply. The Nasdaq slid. Investors are suddenly asking whether the AI-driven rally has gone too far. Today, I'm going to tell you exactly what is happening, why it is happening, and what the intelligent financial response looks like. What caused the 80% surge in the first place? Artificial intelligence spending exploded in 2026. Companies like Nvidia, Broadcom, and AMD became infrastructure of the AI era like oil companies in the year century. Investors poured money in, anticipating that AI would reshape every industry. The earnings followed first quarter 2026 earnings. Growth came in at the highest level since 2021. Why the pullback is happening now? After an 80% gain in 6 months, investors are asking a simple question: are these stocks actually worth what the market is paying for them right now? Concerns about whether AI optimism has pushed valuations beyond reasonable levels are growing. When OpenAI, the most important AI company in the world, started discussions about selling a % stake to the US government, markets read it as a signal that even the biggest AI players need capital. Meta announced it may start selling excess compute capacity, a sign that AI infrastructure spending may have been overdone. What this means for regular investors with index funds. Your broad market index fund is exposed to this technology concentration. When tech falls 2.6% in a session, while the Dow rises 1%, you are experiencing the tech drag. This is not a reason to panic. It is a reason to understand what you own. The most important historical context. Every major technology rally in history has had significant pullbacks during the broader trend upward. The internet boom had multiple 30% corrections before the eventual crash. The post-2009 tech rally had multiple 20% corrections before reaching extraordinary highs. Pullbacks within bull markets are normal. They feel catastrophic. They are historically buying opportunities for long-term investors. What the intelligent financial response actually is: do not sell, do not try to time the bottom, do not shift your entire portfolio to cash because tech is falling. Continue your automatic monthly contributions. If anything, a period of falling prices means your regular monthly investment buys more shares than it did last month. That is mathematically beneficial for long-term investors. The one thing to review is your overall portfolio concentration. If your investments are heavily weighted toward single-sector technology, this pullback is a useful reminder about diversification. A globally diversified index fund automatically rebalances as sectors rise and fall. That is the structural advantage of index investing over individual stock.